Hello and welcome to Profit Playbook. Today we're going to look at decisions about selling your business. Do you sell now, get all the money out in one go, or do you extract profits over time? I'm your host today, Tracey Metcalfe, and I'm joined by Scott Harris, also a director here at Green & Co. So let's get started. Welcome, Scott.
Hiya.
So before we get really into the nitty-gritty of today's conversation, we looked about profit extraction from in a previous episode and looked at remuneration, how directors take their salary. So you can just take a brief description of how they normally take that salary from a business.
Yeah, I mean, in multiple different ways. There's quite a few common scenarios, like from a company's perspective, then we'll argue it as basic salary, dividends is the very common approach. Most people would take their earnings and salaries that way. You've got other styles of extraction as well, such as pensions, which can be a bit of a more long-term strategy for some people. I mean, depending on your age, it might be a short-term strategy. But also benefits in kind as well, like company cars and insurances and things like that as well might form part of your benefits package overall, and where you again, the company effectively to pay more for stuff that you would normally pay for yourself, and therefore it's more tax efficient for the company to pay for it than you. So that's all about profit extraction, really, in that respect.
So there's lots of ways people can extract money from a business.
I mean, it's the levels then as to which you go, depend on different people, and their circumstances.
So how can these decisions affect the future of the business? Say you're thinking about selling up in a few years' time. How does that profit extraction affect that now?
I mean, sometimes it will and sometimes it won't. You've really got to look at your certain circumstances and maybe even your outside of the business. You've got to look at your lifestyle and what you've got going on as well. You still want to crystallize or maybe effectively tax then the earnings at the lowest rate of tax possible in any one given year. That's usually the main argument behind why you're doing any of this. So you still want to do your basic rate band planning, so taxing earnings up to the maximum of 50k as much as possible. It's where a lot of low rate taxes are taxed, so want to maximize that every tax year as much as possible. Even if you were having an impending sale, if you're not exhausting that right now, then that's actually a good thing to start looking to do, is to try and exhaust that. I mean, the other side of it then is it suitable for you to look at other options as well? For instance, you might have a very, expensive lifestyle, for instance. And we know plenty of people, some more modest than others, but some people need a lot of cash in order to maintain their lifestyle, and that's absolutely fine. But it may push them into taking more dividends, maybe going over a certain threshold in which you may start wondering, is it worth to take more salary over dividends, i.e. cash? They need more cash in their hands and they got a different type of argument to play with, compared to maybe someone who doesn't quite need all that money yet and they're happy to take that money over many years into their retirement, for instance. Pensions then could be more of a maximization tool for someone like that, instead of considering too much of salary and dividend planning, for instance. So you really got to look at the person and look at what they're trying to do and what their goals are outside of the business, and even post sale of a business as well, as to what kind of plan you're really going to be putting in place. But they're the sort of conversations you'll be having with yourself or your advisor.
Yeah. So we recently covered the tax changes and how that's going to affect these decisions going forward. Can you, how does that affect drawing income now or leaving it in the taxes around when you sell a business?
So business asset disposal relief, it was previously entrepreneurs relief, as most people may know it as. It used to be quite a valuable relief where you tax quite a lot of the disposal proceeds from the business at 10% capital gains tax treatment, at least up to the first million. It used to be even better than that in the past, believe it or not. Now it's eroding over time, and over the last 2 years and more effective now from the next tax year on, it's becoming more in line with the main rates of capital gains tax. So this business asset disposal relief is pretty much eroded now in effect, to the point where it's asking this question: is it worth even bothering trying to keep your wealth in a business and eventually crystallize it and pull it all out via capital treatment, or whether or not to start extracting it via salary, dividends, etc. Maybe even trying to save corporation tax in between. Again, my argument goes back to the first point really, which is it all depends on you and your business and your personal goals outside of the business as well.
And we're all different like that. Obviously, we've all got different goals in life, haven't we? So
we're never all the same, unfortunately. You go down the similar channels of looking at assessing a specific person, what of these components are suitable for you or not. But it's all about a special mix of all of the above, I feel, is going to be the right planning goal for you. But looking at it from the disposal perspective, for instance, if you're looking to plan to sell a business in time, and maybe you want to pull cash out over time instead of leaving it in the company, well, the other side of that is that the value that you may look to realize in the future may not even be in the company there yet, because you may sell the business for a premium, so there is no cash to extract yet, which poses a different type of planning opportunity in the future if you really don't want to crystallize it to capital gains tax treatments. The main rate of capital gains tax is 18% currently, and the higher rate is 24%. So with business asset disposal relief coming in line with main rates at 18% for the first million, yes, there's still a benefit, and even 18% of 24% is still better than potentially the income tax rates going up to, say, 47% or so. So if you were, it again depends on your lifestyle as well. If you were happy to tax all of your income at the basic rates for the foreseeable, and always taxing that surplus income at the lower rates, then potentially there's a saving there. But more often than not, you want to access all the income, you want to tax it at the cheapest rates possible now, all in one go. Capital gains tax treatment is still very much favourable. In spite of it getting worse, it's still currently more favourable. So yeah, you just need to be mindful of potentially there are risks with holding the cash still in the limited company, and then pulling it out over time effectively. But more often than not, people will still find the capital gains tax treatments more favourable.
So is there a risk, like, if delaying those decisions to take it out in the future? I mean, who knows what's going to happen with tax rates in the future? Is there a possibility,
Yeah, exactly that. You look at some of the U-turns that the government have brought in recently, and also some of the changes in the capital gains tax planning and the freezes around income tax treatments as well. They seemingly are getting worse. Let's hope that it isn't going to continue to get worse. But we know that there have been some agendas that capital gains tax rates and thresholds, etc., are trying to become more in line with income tax anyway. So potentially delaying this issue into the future, you might find yourself into a capital gains tax issue if you later decide that you want to pull the rest of the cash out, for instance, but then you have to go down capital gains tax treatment routes anyway, and they're less favourable in the future. There's a risk. Income tax could also go up in that space of time. Your needs may change, which may impose a different risk on getting access to that cash as well. Again, time, it sounds great right now, but we know tax never stays still, and it seeks to change at least every year for our sins. So we do need to be mindful that the tax planning now may not always be relevant for the future. So you'll have to have continual planning, which may even be continual costs, accountancy costs as well, to maintain structures, of course, as well, to keep these entities active so that you can continue to pull the cash out. So there are those other types of costs that you wouldn't really talk about.
That's two important things that I've just picked up on, is particularly tax changes. You don't know what's going to happen. And in your life, we plan these things, but we don't know what's on the corner in our life either. So
Yeah.
Sometimes that makes it really hard to...
It's quite soul destroying sometimes.
It is,
when you're sat there with a client and you're trying to plan their life and you're trying to help them navigate what are very complicated areas in their life. And then you do a nice bit of project work and everything looks great. Everything's done, everything's tickety-boo. It's exactly what they wanted. It's exactly in line with how they expect things to go moving forward. Then all of a sudden we have another budget and it changes things. Or a life event happens for the client and changes things again further. Or maybe it's not 1 year later, it's a couple of years later and they're getting back in touch with you. It's very common that things just don't stay the same. So you can only plan for what you know now.
Yeah.
And the longer that view of potential retirement or the planning or planning window is, the more likely it is that it's not going to be the same as when you set out to plan for the end now. So it's just being realistic there.
Yeah,
I think a lot of people don't actually think about that.
Yeah, no. But that's why it's important to review your plans regular,
Yeah.
rather than just, well, this is my your 5-year plan, and don't look at it again. You know, it's important to sit down each year. Anything changed?
Yeah.
And particularly speak to your accountant or professional advisor about these changes.
Exactly. Tax planning in general, just as a caveat to all of this, is you try to tax and crystallize the profit as much now as you can, because the certainty is now, you know the tax rates now, you know the treatment now, and that is then traded off with the risk of things changing in the future. I mean, it could get better in the future, but it typically has more often than not recently got worse in the future. So we've always got to worry about that. But yeah, I think just having a bit more of a pragmatic mindset when it comes to planning and a realistic mindset, and then speaking to your advisor to assess all your options and doing a little bit of planning about what if this happens, what if that happens. More often than not, you'll find that you'll create a plan that is a little bit more open and allows you to change and divert and modify it as time moves on, in line with potential changes that may come up in the future as well. But keeping your finger on the pulse is definitely key. Yeah,
so what I've got from this conversation today is that strategy is important, your goals in life are important, your lifestyle. Is there anything else you could add before we complete today?
I think you've nailed it really there. It very much depend on the person and who you are and what you're setting out to do. Your life goals after a sale, or even currently, while you're in the business, are really, really, really important. And then
look at the taxes.
And then just look at the complicated bit of the taxes, to see what actually fits better to you. It never works the opposite way. I'll say that much. If some people it can, I'll have to say, some people do live their life to the tax rules and changes, but more often than not, if it doesn't actually accord with your version of what life should look like, then it doesn't often work. You often find that you're causing yourself more problems in the future, one way or another, whether it's personal or business. So just be realistic with yourself as well, I think, and maybe to add to that.
Right. Thanks, Scott. That's a great conversation.
That's brilliant. Thank you.
Well, there was some really good advice in there today from Scott. I hope you at home found it really useful. Is there anything you want to reach out to us for, just please contact us. We'll be more than willing to help you. And just want to say thanks again for listening, and don't forget to like, share, subscribe, and we'll see you again soon.